Hey everyone, this is Dave with another innovative investment idea for your consideration. Today, we'll be looking at how to objectively analyze a stock, as far too often people blindly invest into a company without doing their own research. But before we get started, don't forget to hit that subscribe button if you're new to my channel to get more stock market content just like this. Okay, let's dive right in. There are literally thousands of publicly listed stocks in the US on the two main exchanges, approximately 3,300 on the Nasdaq and another 2,800 on the NYSE, and even many more thousands of stocks on exchanges all over the world. It can certainly be overwhelming even for the most experienced investors to choose which ones to invest in. The investment choices are almost endless, but on the other hand, our capital is not, so it is therefore vital that we consider our choices carefully and to determine which option will potentially maximize our returns over a period of time. You've no doubt heard the expression, "there ain't no such thing as a free lunch," coined by author Robert Heinlein in 1966, but was later popularized by economist Milton Friedman as a restatement of the opportunity cost economic principle, which teaches us that the time investors spend eating a so-called free lunch could instead be spent on other pursuits such as working or making money, and thus is not actually free. As a real example of an opportunity cost conundrum, if an investor had $1,000 to invest in the stock market today, where should that investor begin to weigh his or her options? A complete novice might struggle with this question more so than a seasoned investor looking for the objectively best current opportunity, but ideally both would go through the same thought process even if the latter arrives at an answer sooner. Is Wendy's a good stock to buy, and how does that compare to Foot Locker, for example? Or perhaps Tiffany's, or even Pepsi is the best option. Or maybe another stock entirely. The purpose of this video will be to help investors examine this question through a critical lens and to explore the tools and information freely available on the internet before attempting to answer, but more importantly, why one stock might be more suitable than another depending on the circumstances. The why is always key in objective thinking, as any philosopher would tell you. Furthermore, stocks only represent but a single slice in the huge metaphorical pie of possible investment avenues for our capital. Other common asset classes include bonds, real estate, mutual funds, exchange-traded funds or ETFs for short, commodities like oil and gold, or even an interest-bearing savings account at the local bank. Not to mention alternative assets such as art, vintage cars, coins, or direct venture capital for a startup. In this video, however, I will be limiting the scope to just stocks, as arguably it is the most accessible investment vehicle for the masses, and in a large sense, it is one of the great equalizers. Stocks are liquid, which means investors can always buy and sell on their own accord and aren't constrained to holding for any extended period of time other than the hours between market open and close, Monday to Friday, in stark contrast to real estate, for example. Additionally, anyone can start investing even with as little as $5, as there are some stocks out there that sell for less than that, otherwise known as penny stocks, all the way to millionaires or even billionaires who have the ability to buy the very same stocks, albeit in much larger quantities. Okay, so where does one begin in the process to determine which stock might be worth an investment in a vacuum, or perhaps when pitted against another stock? Naturally, company-specific news as well as how the economy is doing at large are both relevant, but let's first consider company-specific valuation. There are actually dozens of methods already out there, but most analysts and traders usually subscribe to a mixture of ideas or even their own method depending on their risk profile, timeline, or predictions of the future. But one common mathematical-based approach is a discounted cash flow, explained here in Investopedia, which essentially takes into consideration how much cash the company will make in the future and attempts to value that as a present-day figure known as intrinsic value, which can then be directly compared to the current price to see if it is above or below. If the intrinsic value is above the current price, then clearly the stock is a buy, but if the intrinsic value is below, then that indicates the stock is a sell if it had been previously bought, or for the investor to abstain from buying until the price drops below the intrinsic value in the future. Again, this is one of many approaches, as on the left, Investopedia outlines a multitude of other common methods used by analysts and retail investors alike. It's critical to note that formal approaches and even professional analysts don't always get it right, even when applying these methods, especially for growth companies that are unpredictable or hard to gauge. When Tesla experienced a meteoric rise from an approximately $300 stock to over $900 between late 2019 and late February 2020, this caught many in the industry off guard. Short sellers, including one of the most noted Tesla bears in investment circles, billionaire investor David Einhorn, as well as a significant portion of professional analysts at the time, were recommending the stock be sold or had much lower price targets. Even though the stock suffered a precipitous drop like every other stock due to the global health issue, it has since found an equilibrium somewhere in the 700-800 range, and only now have analysts adjusted their price targets to be more in sync with reality. The truth of the matter is that no one really knows where the stock price of a company is going, only an educated or informed opinion, especially in the short term where most stocks tend to be volatile and market forces dictate based on supply and demand more so than fundamentals. As such, this video does not formalize a precise approach, but is more of a holistic and general examination that is part based on intuition and logic, but also partly rooted in mathematics and data. It should be a very handy guideline for everyday investors who don't want to get too far down the rabbit hole, but enough to justify a purchasing decision or a cursory comparison between two or more potential options. So without much further ado, here are the key factors that I personally think should at least be considered at a bare minimum, in addition to any mathematical models out there. The first point to consider is what category does the stock in question fall under. In a previous video, which I will link in the description and also at the end of the video, I discussed dividends, growth stocks, and safer blue chip as the three primary categories worth investing in. If an investor is looking to build a steady stream of income, or just somewhere to park their money for the next 3 years and collect maximum capital gains, then the choice should already be made simpler after considering the stocks category. The next point to consider, what does the company do? Is it in a promising industry that society is moving towards, such as renewable energy or science-based medicine, or is it a more traditional/legacy player in food and beverages or a manufacturer of household furniture? Investors should ask themselves what are their general thoughts about the company's products or services, whether the company is forward-looking and not stuck in the times, has access to a large addressable market, and generally how it fits into the grand scheme of things. For example, if we consider Apple randomly, it has an extremely large and loyal customer base, a high approval rating amongst users, is a major player in the manufacture of phones, laptops, pads, and accessories, and has access to potentially billions of customers in every corner of the globe that end up trapped in their walled garden. SoFi passes the litmus test for this criteria, but no conclusions should be made until after all the factors to follow have also been considered. The research here should involve going to the company's website, looking at their mission statement, products, customers, and generally thinking about how the company is perceived by the masses. If the answer to the original question of what the company does is murky or does not give one confidence, then this is probably a big red flag and investors would be wise to think twice about investing, as the risk could be unacceptable. Next, what's the company outlook when factoring in competition and how much market share it has? Has the company made an important change recently, such as reducing the number of employees indicating cost cutting? Has it acquired other businesses? Or maybe the government has passed a new law that benefits the company? During the current pandemic, airlines and travel stocks have come under the pump, and large macroeconomic factors like this are definitely worth considerations. Tech stocks, for example, should tend to have a much more positive outlook from this point moving forward, as we look at the global health issues in the rearview mirror and a new normal for society, while traditional retailers might struggle. Another important point to consider is whether the company is disrupting its industry. Is it forcing the incumbent players to adapt or seem redundant? If so, that is definitely positive for the outlook. Investors should look for press coverage from their favorite news sources such as CNN, CNBC, Investor Place, Seeking Alpha, and just generally Google searches to try and discern for themselves what is material and how that relates back to the company in question. The first 3 points are largely based on personal opinion and intuition, but are important because it's definitely not recommended for investors to buy into something that they don't believe in or don't understand. Just ask the Bitcoin bandwagoners who bought in during the late stretch of 2017. The next 2 points, however, require more deep diving and quantitative internet research, which will be the primary focus of this video using a real example. But before we get there, the 4th point to consider are the basic ratios and valuation metrics of the company. What is the company worth? How does that compare to its competitors in some key ratios? And does the current valuation make sense? Is it too high or too low perhaps? What is the company's net profit, revenues, and what does it look like in terms of assets and liabilities? If any of these factors look askew, investors should approach it with increased caution. Again, we'll get more into the weeds of this point in particular shortly. The final point that might help to decide whether a stock is a worthy investment is to consider what the stock price is currently doing. Technical analysts and impatient investors generally jump straight to this point, but is usually the last thing the wise or long-term investors tend to consider. If, after considering the first 4 points, an investor's long-term thesis of a stock indicates that it is worth a lot more in the long term than the current price, then the stock price is irrelevant and is a no-brainer buy and hold. If on the other hand this is less obvious, or the purchase is intended as more of a short or medium-term trade, then the price action is important. Waiting for a pullback or correction for a cheaper entry is the name of the game. There is also merit in the contrarian and momentum investment theories, where timing is based on current price trends, which then allows buyers to act accordingly. As the great Warren Buffett often says, be fearful when others are greedy, and greedy when others are fearful. Collating all these 5 points together to sum up the general method, it will be easiest to illustrate via an example. In this video, I've selected Facebook, ticker symbol FB, Foxtrot Bravo, as a stock to analyze. We know its category is somewhere between blue chip and growth. It is the world's leading social media company with over 2.6 billion monthly active users as of the first quarter of 2020. It generates the second most ad revenue globally behind only Google and is continuing to outpace direct competitors such as Snapchat and Twitter. It disrupted entrenched news outlets and digital advertising agencies and continues to do so with the recent announcement of Facebook Messenger Rooms to challenge the rise of Zoom, and Facebook Shop on its Facebook and Instagram platforms to combat e-commerce companies like Wayfair, Shopify, eBay, and Amazon. The soft or qualitative research has revealed this much so far, and that this looks like a solid foundation to build a long-term investment case. But let's now dive to the fourth point, which is ratio analysis and examining of the financials. A great resource used by many retail investors is Yahoo Finance, which provides access to all of the listed companies' income statements, balance sheets, and cash flow statements. It's free and has heaps of information accessible to the public, so in this video we'll use this tool, but of course investors should feel free to use their own tool of choice. On the Summary tab, we can immediately find a few interesting pieces of information we'll cover in this video, and even more information that unfortunately won't be covered in this video as it would take too much time. The first is the 52-week range, which shows us the lowest price and the highest price throughout the last year. The wider the range, the more volatile the stock, which might affect the decision for short and medium-term trades more so than long-term trades. It could also give us hints as to a good entry point if the current price is sitting closer to the lower end of the spectrum. We'll also see the market cap, which in of itself isn't an indicator, but could provide an additional clue that might be useful at times. As an example, I tend to group Facebook in the same tier as Google, Amazon, and Microsoft, but they are all valued at 1.3 trillion plus, so straight off the bat, my gut feeling is that FB has the potential upside from 600 billion to a trillion when it finally catches up with its peers in terms of raw valuation. I'll discuss the PE ratio shortly, but the other interesting piece of information is the ex-dividend date for any stocks that pay dividends. This can affect timing of entry, as investors who purchase the stock before this date are entitled to the next dividend payment, while those who purchase the stock on the ex-dividend date or after are not. Moving on to the Statistics tab, we have some important ratios to consider. The three key ones I'll discuss in this video are PE, both trailing and forward, PEG ratio, and price to sales ratio. Trailing PE or price to earnings is the most commonly used because it offers the most accurate valuation of a company using historical earnings in comparison to current prices. It is calculated as the current price divided by the earnings or net profit per share from the previous period. The higher the number, the more expensive is a stock relative to how much earnings the company has generated. It's noteworthy that companies with losses or no profit would generally not have the PE ratios reported. To put it another way, it's a dollar amount an investor pays for $1 of the company's earnings. So in this case, for the period from December 31, 2019 to March 31, 2020, investors paid $25.94 for every dollar of Facebook's net profit. This ratio value, just with any of the others we will discuss, should never be considered in a vacuum, but always in comparison to the index, or even better, its peers in the same industry. The historical average PE ratio on the S&P 500 is approximately 20, but internet services and social media companies have an average of about 31. So in this regard, Facebook seems slightly undervalued, which is most certainly a point in its favor. The forward PE ratio is very similar to the trailing, but instead of being backward looking, it uses the earnings for the upcoming 12 months. Because the exact amount to be earned isn't yet known, it's only an approximation, but gives us insight into what we might expect in the future, which is generally preferable for growth companies. In Facebook's case, at the current valuation, the suggestion is that investors will be paying essentially the same amount as for the trailing. Keep in mind that due to the global health issues we're experiencing, ad revenues aren't expected to grow much in 2020, at about 10% as we'll see later under the Analysis tab, so this makes sense that the forward and trailing are similar, since its earnings won't be improving materially. The price earnings to growth or PEG ratio is the PE but divided by the expected EPS growth. To put it in simpler terms, the PEG normalizes the PE by factoring how much growth in earnings the company experienced in the last year. Yahoo doesn't specify if it is a forward or trailing PEG, but investors will see that distinction in some cases as well. The degree to which a PEG ratio result indicates an over or underpriced stock again varies by industry, but as a rule of thumb, if the PEG is more than 1, it is considered slightly overvalued, while a value less than 1 is considered undervalued. Facebook seems roughly fairly valued according to this metric. Finally, the price to sales ratio is the stock price divided by the sales the company has made per share. So in Facebook's case, the current price of approximately $231 divided by 25.71 revenue per share will give us the 9 as reported. The average PS ratio of the S&P 500 is about 2, and for internet services and social media companies, it's about 6. So in this regard, FB is trading at a slight premium compared to the market, but not excessively so. It should be noted that in these calculations, I've only been considering the current period, but clearly it's possible to look at previous years or quarters as well. In this section, we should also take a quick note of the amount of shares outstanding as well, at 2.4 billion, as that will be useful knowledge when looking at some of the items later on. But what the number of shares outstanding tells us is the total amount of shares in existence that collectively comprise the 100% ownership of the company. So having looked at the ratios, the general takeaway seems to be that Facebook is perhaps marginally trading at a premium, but does not appear unfairly priced by any stretch of the imagination, especially when compared to its peers or the market. We will abstain from any conclusion as yet, however, since we have more data to examine as we move on to the income statement under the Financials tab. For this, we'll look at the period from 2016 to 2019. There's a lot of information here, so we'll only look at the main line items. The first line item is total revenue, which is the amount of money the company generated. The primary point of interest here is to look at the year-on-year growth, which in Facebook's case is quite impressive, even if it has shrunk from 47% between 16 and 17, 37% between 17 and 18, and 27% between 18 and 19. It's plausible that some investors see this slowdown in growth as a red flag, which might be what is holding back the stock price. The next key line item is net income. The noticeable feature with FB is that the company was becoming increasingly profitable from 16 to 18, but then suddenly generated less net income in 2019 as compared to 18. This might look slightly worrying until we dig a little deeper and notice that the company had a significantly higher, in fact almost double, the selling general and administrative costs from 2018. It's possible to dig even deeper into the rationale here, but the reason should be the numerous fines which are settled in court, including the Federal Trade Commission's $5 billion fine in relation to Facebook's failure to safeguard user data, and the European Union's $4 billion lawsuit against Facebook for failing certain aspects with regards to GDPR. The understanding is that these were one-off expenses, so it would seem that Facebook should resume generating at least $22 billion of net income again from 2020, based on the figure from 2018 plus growth. Basic EPS and diluted EPS are calculated by dividing the net income by the number of outstanding shares, which we noted earlier was 2.4 billion. EPS only takes into account the 2.4 billion, whereas diluted EPS takes into account all convertible securities that have not yet been exercised into shares. Since EPS is a reflection of net income, it should be positive if the company made a net profit and negative if the company suffered a net loss. Outside of exceptional circumstances, it is generally not advisable to invest into companies with negative EPS unless the growth in revenues is accelerating rapidly. Moving on to the balance sheet, we see that there is too much information to go through line by line, so in the interest of being concise, we'll focus on the current assets and liabilities, that is the short term and not the long term. It's important for companies to maintain a stockpile of cash on hand in case of an emergency, such as we've seen with the current pandemic. Having cash on hand means the company can withstand any short-term hits to its business and can continue operating without imminent threat of bankruptcy. We can see here that Facebook has almost $55 billion in cash and has been quite diligent about growing it from 2016. Cash equivalents are essentially short-term securities that the company can liquidate or convert to cash without much notice, and as the name suggests, is as good as having cash on hand. Finally, net receivables are invoices that are due in the near term from its customers. Overall, Facebook has a very healthy $66 billion in current assets. The liabilities, on the other hand, are comparatively very low. Facebook's debt, accounts payable, and other liabilities combine for a meager $15 billion, suggesting that if Facebook were inclined to pay off all of its short-term obligations, it would still have $50 billion in cash left over. This is an enviable position for essentially every company out there, and is certainly not the norm. This part of the analysis definitely suggests Facebook is in a very stable position financially. As a side note, a common measure of a company's liquidity is known as a quick ratio and is found by dividing the total current assets by the current liabilities. A value of 1 or more implies the company can meet its current obligations, and a value of less than 1 means that the company has elevated risk in terms of being able to pay their short-term obligations. Obviously, Facebook has no such concern since its value sits at well over 4. The last item to note on the balance sheet is the stockholders' equity, which is the remaining amount of assets available to shareholders after all liabilities have been paid. In other words, it's a total amount of value the company retains within the business itself once it has nothing due. A negative value here may also indicate an impending bankruptcy. Next is a cash flow statement, which is generally less important to consider when compared to the balance sheet and the income statement when assessing the company's viability as an assessment target. This is because a company is usually assumed to be making the best choices with regards to its cash, assuming the cash reserves on the balance sheet did not raise any immediate red flags, which obviously with Facebook we do not see. In any case, the cash flow statement is divided into 4 subsections: the cash generated from operations, cash used to reinvest in the business or make acquisitions, cash used to repay obligations, and the amount of cash added or subtracted from the cash on hand it previously held. There are a lot of line items here, and things such as depreciation and amortization, which are more useful for accounting principles, won't be discussed in this video. Under the net cash generated from operations, we see how much the company awarded its employees and management in stock-based compensation, and the change in accounts receivable and payable. In the next subsection, we see how much a company has spent on new property, plants, and equipment, and how much it paid for companies it had acquired during the period. In this instance, we can see here that Facebook spent about $15 billion on a new office or building, and also acquired smaller companies for a grand total of $491 million. In the subsection below, we can see how much of its own stock a company has bought, that is share buybacks, as a means to reduce the number of outstanding shares, and hence drive up the price, and also any other debt it has paid off with the cash on hand. The final section of the cash flow statement tells us how much cash the company added or used during the period, which we know directly affects the figure on the balance sheet under current assets. Before summing up this last section of the video, let's take a look at the analysis tab. In this section, Yahoo has aggregated and averaged both the earnings and revenue estimates for 2020 and the upcoming year 2021. The takeaway is that retail investors are able to get an idea of what professional analysts are expecting from the company over the next 2 years to help in evaluating the direction of the company. As an example, investors can see that for Facebook, analysts expect only a modest 10% sales growth in 2020, much less than the 27% last year, likely due to the pandemic, but a return to a robust 24% in 2021 once society has recovered from the induced economic coma. So, summarizing all of our findings from the qualitative research, the reasonable valuation metrics suggesting the stock is not too overpriced, the growing net income, aside from 2019 being affected by a couple of major fines, the healthy balance sheet with $50 billion more current assets than liabilities, and a cash flow statement demonstrating even more cash being added, seem to suggest that Facebook is an extremely attractive buy for the long term. Short or medium term investors should continue to process the information and look at the price action based on the trends of the market and the stock specifically. As a final word, the point of this video was not to analyze Facebook per se, but merely use it as an example to help illustrate the thought process that investors should have and how to relate the information into a go or no-go decision when assessing whether or not to buy a stock. That about wraps it up regarding what to look for when buying a stock. I'd like to know what your thoughts are on the overall process down below, along with any other questions or comments. Also, don't forget to hit that like button if you found this video helpful or insightful. Before I go, click on the left for my analysis of Alteryx and click on the right for a general overview on the 3 types of stocks in the market today worth buying. As always, thanks for watching and I'll see you in the next one.